Do you believe the market will show a correction in the coming days due to the Federal Reserve's recent meeting regarding increasing interest rates? Yeah. So I can never call the market on a short-term basis. Nobody can. Otherwise, we're fooled by randomness, which is the title of a great book by Nicholas Taleb. Everyone's got to read it. Yes, he also wrote The Black Swan, which means a rare event. You can't focus on how the market's going to react because a lot of times the market reacts based on a black swan, which is a rare event you can't predict. You can't. And each month has 20 trading days. That's 20 weekdays. And trying to think about how a stock will react in a month, in 20 days, is impossible because you get fooled by randomness. What happens is stocks go up or down based on geopolitical events outside of your control. It might be saber rattling between DC and Beijing or Moscow and Riyadh with the price of oil, etc., which makes stocks go up or down. You can't focus on that stuff. Or it might be another stock similar to one you own that reports good or bad news. You can't do it that way. You got to be very, very long-term focused. Now, the reason why rates have been artificially low for an extended period of time is because the government sees data that we don't look at that closely, but they see data about COVID, which is kind of scary. Okay. And as a result, governments around the world, to make it easier for people to invest in the economy, et cetera, they've made rates zero for an extended period of time. And they've done that because they've run out of medicine to fix the economy. And so the way it works is there's two types of medicine to fix an economy. It has nothing to do with COVID, medicine-wise. The first medicine is monetary policy, which is the policy of money. And monetary policy means interest rates. And so interest rates are basically zero now. Can't go any lower. So we're out of medicine for the monetary policy bottle. The other medicine is called fiscal policy, which is spending money on bridges, tunnels, whatever it is, defense, in order to prop up the economy. Okay, and the stimulus packages. And we're kind of out of bullets for that. There's only so much more money we can spend before countries go bankrupt. And the next generation calls it the steal from us program, so the stimulus program. And so there's no more bullets left in either medicine bottles, meaning monetary policy and fiscal policy. So what? What do you do next? Well, you create something called the wealth effect, which means you leave rates at zero for longer than expected. And what happens is because rates are 0%, we don't leave money in the bank. Because if we do, we're not going to make any money on interest. So it encourages us to buy stocks and speculative asset classes like NFTs, etc. I won't go there. But if everybody owns stocks and stocks go up a lot, then the wealth effect kind of helps the economy because everybody feels richer and everybody spends more money on stuff. Okay, and tax revenues go up, etc. Okay, and it's not sustainable in the long run. But governments around the world, they've left rates lower than expected for longer than expected because they know that if they raise rates too early and another COVID spike emerges, then you could have civil unrest, like real civil unrest. I'm not going to go there, but I think you could read between the lines there. Okay, think 1989 Tiananmen Square. If they raise rates too early, there's civil unrest. And so the problem with this, and I agree with what governments have done, by the way. Yeah, keeping rates very low. Makes sense. But the problem with this is that you get inflation. We all know there's a shortage of, from a supply chain perspective, every product out there because rates are zero. And we all know that prices of everything are going up a lot, which is why one of my bigger investments is something called Treasury Inflation Protected Securities, or TIPS, which means you buy U.S. government debt that goes up every year, the same rate as the interest rate plus inflation, so 7% or 6% of the past year.